All right, guys. We are really excited for today's webinar. We're always excited when we get the chance to speak to a live audience because this is your opportunity to engage with us. Let's have thoughtful discussions and let's really understand what we mean when it comes to this banking world that we are all living in. So today, what we recognized is many of our clients or prospective clients or people who have policies reach out and go, I have a policy. Now what? So we said, you know what, let's have a webinar where we can actually walk you all through one scenario of just paying off debt. Because we recognize that literally half of America is in debt. What's the percentage? 5,000, 6,000?
$6,000
of credit card debt at minimum. So why not? Let's talk about debt today. Our next webinar in September will be all about cash flow and how we're using our policies to create cash flow. So we wanted to make sure that we had the opportunity today to just break down debt and show you all what that looks like.
Right. Now, as we go through the numbers, don't get overwhelmed by the numbers. We're going to explain it to you in detail. If you have any questions, please let us know. And we're going to use debt as an example here, but we're going to build on it. Last month, what we talked about is how to create a policy. And then in our money school, we talked about how you can create a policy just like an agent. Now, moving on to the next step, since you guys already have a policy or looking at what you should be doing with the policy, this is what we're going to be discussing today. We're starting with debt, and then we're going to work our way forward.
Absolutely. So like Darius said, if those of you who are with us, if you haven't heard of the Wealth Nation Money School, then definitely click on the link in the description below. This is basically our labor of love. We recognize that we have so many, again, clients, prospective clients, and just individuals who are not our clients, but have policies, and they need direction, they need guidance, and want to be amongst others who are also doing similar amazing things. So if you are interested in joining the membership, definitely click on the link. We are here to serve, but let's go ahead and jump into the content of what we have to share with you all today. And that is basically, we don't want you all to be overwhelmed. So we want you to create a plan for your system without needing a financial planner, because that can sound really intimidating and really overwhelming.
So first of all, we want to welcome you. You could have been doing anything with your time, but you're choosing to spend it with us. So we really, really appreciate it. And thank you so much for joining us today.
Exactly. And we just always want to put disclaimers out there. Everything that we share is informational only, as educational purposes only. This is to make sure that we can arm you all with the tools that you need to make your goals happen. So if we jump into the rest of the information of everything that we skipped ahead a few. All right. So let's jump into the deets. So like we said, the deets today, we're spilling the tea. The tea that we're spilling today is how to create a plan for your system without needing a financial planner. And the point is, we want you ladies and gentlemen, you all out there, we want you to know how to use your policy without getting overwhelmed, because that's the last thing that you need when you're understanding insurance and banking and transferring money and interest rates and all that stuff. We don't need you to be overwhelmed.
Right. Now, our promise to you is you'll discover the step-by-step process we use to help our clients pay off debt and create cash flow, all while having a peace of mind. Plus, we have some cool bonuses to give you.
Yeah, we always have to come with bonuses. We want to make sure that, again, we provide massive value, and you'll see by the end of this presentation some of the bonuses that we're going to give you all today. So if you don't know us, hello, I'm Carmen.
And I'm Darius.
This is my wonderful husband, Darius, and we are the founders of Wealth Nation. You may have found us on YouTube. We have a YouTube channel called Wealth Nation, and we have also created a course, a financial mastery course called the Money Blueprint. And for us, that is also something that we're really proud about, because what we recognize, again, is just what we are all struggling with throughout the years of just understanding money, understanding our finances, and how can we get ahead with the lack of education that's out there in mainstream.
Right. And I'll even go so far as to say it's maybe not our understanding of money, is our inability to manage it. And that's one thing you'll see, something that's common or that we continue to do over and over again is show you different ways to manage your money. We talked about how we personally use the 50-30-20 rule in our personal account. That's a money management tool. When we go through these numbers and show you how to use your policy, we're basically using Excel as a money management tool so you can see it for yourself.
Exactly. So in addition to the Money Blueprint, we have also created the Wealth Nation Money School, where we are bringing all bankers alike together so we can learn from each other and continue to level up together.
Mhm.
Now, Darius and I, we started our first banking system back in 2016. We have learned a lot through that time and accomplished a lot through that time. And really our specialty, what we consider ourselves as specialists in helping high achievers finance their lifestyle without taking on any risky investments.
Right.
Because contrary to what you believe, you don't need to take on risks if you understand what it is that you're doing.
Right. And what we've been able to do since starting our policy, we had over $140,000 of credit card debt.
Mm-hmm.
Now we have way more than that in investments through our policies. And what we want to do is just show you just basically our journey to get to where we are now.
Mm-hmm.
And we're going to start that with showing you how to pay off some debt.
So why is this information important? This is the biggest thing for us to understand today. This is why we're all here today, right? Is because I hope that you all understand that just starting is important. Starting your banking system is important, but using your policy is really what's going to transform your ability to build wealth.
Right.
Because so many people just get started and then they realize that, wait a second, now I have this policy. Again, the whole point of the title of this webinar is, what do I do with this thing? So again, it's all about making sure that you understand what it is that you need to do. All right. So long story short, we want you all to use your policy, because if you don't, you're missing out on huge gains. That's really what it is. You're missing out on your ability to create more cash flow, to build wealth, and also to protect your family even more aggressively than what your illustrations show you.
Mm-hmm.
And we want you to get out of analysis paralysis so that you can start keeping more of your money.
Right.
Because we know many of you, we go through 7 meetings with you and all you're focused on are the numbers and how the policy is growing. And that's totally fine. We want you to understand exactly what it is. But the question that we keep challenging you all with is, what are you going to do with this piece of paper once it's official? And as we always say, there's no fancy formula. It's just math.
Mm-hmm.
That's all it is. Plain old math. Don't overcomplicate it. All right. So here's the secret. Y'all ready? The secret is we can help you. And you don't have to do this alone. Hence why we created the Wealth Nation Money School. So it's all again about being surrounded with like-minded people who are either a little bit ahead of you, who are in the same trenches as you are, or those who are just getting started. It's all about learning together and coming up so that we can build wealth.
Right.
So let's get started. And what we're going to get started with is literally a breakdown of showing you how to take a policy loan and pay off 2 credit cards. I will warn you, there is a lot of numbers that's about to come onto your screen, but we'll make sure to take our time and break everything down. Let me go ahead and pull up the chat. I just want to make sure that there aren't any other questions or things that have popped up. Perfect. All right, awesome. So let's go ahead and get started. I'll let you take it away, Darius.
So option number 1 is paying off debt. And what we have in front of us is basically an Excel spreadsheet with all of the lines taken out of it, so you can just see the numbers. And before we get into the nitty-gritty details of it, let's just explain this. Paying yourself first is the very first column you see next to our logo. Paying yourself first is the payments that you're redirecting back to yourself. Next, you'll see the policy loan available to borrow.
Well, hold on before that. There we go. So what we want to make sure that you all understand is what we're doing is we're capturing a specific time frame. So we're just going as of this year. Let's say 12 months from now, we're starting in August. Mm-hmm. Happy August, by the way. And we're going until next year. So this whole time capsule that we're capturing here is basically saying, okay, what are we doing for this year with this specific policy loan? So sorry, go ahead.
Right. And then what we're going to do in this time frame from August 21st to August 22nd, in 13 months, we're going to pay off a Visa credit card that has a balance of $7,825.
I have that in red. I have that all highlighted here.
With a monthly payment of $200.
Mm-hmm. And then moving on.
And next you have a MasterCard that has a balance of $5,000 with a monthly payment of $150. Now, this individual has a whole life insurance policy. And what he's going to do is he's going to borrow from his whole life insurance policy, and he's going to pay off the Visa credit card of $7,825.
Now, one thing is that I want to interject really quickly is If you all realize, we didn't say anything about a premium. We didn't say anything about the total money available inside the policy. We're just working with how much is this credit card bill? How much is the balance? $78.25. And the reason why we're not mentioning premiums or how much cash is available, because it doesn't matter.
Mhm.
We don't want you to overcomplicate this. All we're saying is if you have a policy and you happen to have $78.25 inside that policy to pay off this Visa card, pay it off. All the other details, everything, let's not worry about that right now. Let's worry about the cash that we have on hand. And in this particular instance, like we said in this column, this is the policy loan. This is the amount of money that we had to borrow, we had available to borrow, and we're going to throw that at the Visa credit card. So in this instance, now what happens? The Visa credit card is paid off. And what would you do with the $200 that is now available? Let us know in the chat. I'm just curious. You paid off a credit card. What do you do with that cash now? All of a sudden, $200 is now available. What do we do?
Yeah. Now, this is where that discipline comes into play.
Mm-hmm. I see pay the premium, put it on the policy. Okay. I like where you guys
Savings,
are going. Yep.
There you go.
Mm-hmm. You guys are good because you had asked me a few years ago, it probably would have been spent on something else.
Right. And that's why I was saying this is where the discipline comes in place, because what this is a habit. This is a habit that we've created of paying our bills every single month. We don't break habits, we create new ones. So what are we doing with that $200? It has to go somewhere. And the new habit that we create is paying ourselves back.
Yep.
Now, paying ourselves back can be paying that policy premium. Paying ourselves back can be putting it in our miscellaneous account or our separate account. You're redirecting those funds back to yourself. As long as you can do that, you are reprogramming yourself to redirect money. And that's exactly what we're trying to accomplish in this example.
And I'm glad that you said that, Darius. So many of you in the chat, thank you again for your engagement. So many of you said pay myself, pay the policy. So just to reiterate exactly what Darius says, that's synonymous. If you pay yourself, meaning you put that money in the bank in a savings account, segregated account, miscellaneous account, whatever you've heard us say, you can put it in a separate checkings account, or you can pay the loan back towards the insurance policy. Either way, you're paying yourself because you still have control of those funds. Whether it's at the bank up the street or if it's at the insurance policy, you're still in control of those funds. So it's just dependent on what you want to do. Some people prefer to put it in a checkings account and then save it until the end of the year, maybe, just so that you can have liquidity. And what I mean by liquidity, I mean just the fact that you don't have to call the insurance company, request the loan, wait a few days and get it. Others prefer, nope, send it back to the insurance company. I don't want to see it in the bank, which is fine. Again, this is your system. You're in control. You make those decisions.
Yeah, the pros of putting into a separate account or a miscellaneous account is the fact that that money is liquid and you have access to it to pay off more debt more aggressively if you want.
Yeah.
On the other hand, if you want to pay back the loan, what you're able to do is reduce the amount of interest that you have to pay on that amount, because the policy wasn't outstanding for as long of a period of time as if you were to put it in a separate checking account. So there's benefits and perks to both. The most important thing is you have the ability to make your decision, and paying yourself back in either situation puts you in a really good position to continue paying off debt and moving on to the next phase, which is investing.
Yeah. Now, one thing that I realized that we didn't mention is that the terms basically for how long we were going to pay this credit card is 48 months. So when you think about 48 months, that's a significant amount of time that you would be paying $2,400.
Yeah.
And in fact, if you all, can somebody do the math for me? What is 200 times 48? Go ahead and put it in the chat. 200 times 48, $200 a minimum payment times 48 months. Let's think about that for a second.
It's 9,600.
Of course. I know Darius knows it. We're getting engagement. So thank you. To 9,600. So just put that into perspective. The balance, how much is the balance? $78.25. But if we're paying $200 times 48 months, we end up paying $9,600.
And that difference is that
Hmm.
opportunity that we're gonna get into that
Mhm.
in a little while.
Just start thinking about that. Okay, so moving on. Like we said, we're gonna now that this card is paid off, we're gonna take $200 and start pocketing it for ourselves. This is where we say we're starting to pay ourselves back. So in this instance, what we're gonna do is for this whole year. Remember, we're talking about a 12-month snapshot. Is we're gonna pay 200, 200, 200, 200 every single month without fail. Why? Because you would have had to pay Visa.
Anyway,
Visa would have been calling every single month. So we're going to do the same exact thing that we would do. Like Darius said, we don't stop habits, we create new ones.
yeah, we don't break habits, we just create new ones.
Exactly. So then what do you all think is going to happen right here? In August of 2022, all of a sudden our payment to ourself changes. And then if you see here, we have a new policy loan that's become available.
Yeah, because this is an annual premium. So what happens a year from today or a year from August 2022 is there's new loan available for you to borrow. Now, the Visa credit card is paid off and we didn't have enough funds to pay off the MasterCard initially. So we had to wait 13 months until we have a new loan available. So we didn't change anything other than inserting our life insurance policy.
Right. Because the monthly payment, you're going to continue to pay to MasterCard. So in this instance, we just want to make sure that you all understand nothing's changed. The same money is still going out. It's just redirected differently.
Right. So what we have is $8,300 available as a policy loan. And if we add the amount of money that we pay back to ourselves minus this payment of $3,731.75, because this is what is still owed on this MasterCard. This is what's left over after 13 months of $150 payments on a $5,000 balance, $3,731.75. After we've paid this off to zero, we still have $7,320.75 available to borrow from our life insurance policy. So what do we do with that $7,320.75? If we don't have any more debt, that's when we start investing. If we have a business, that's when we start lending money to our business. That's when we do peer-to-peer lending. Once we get out of debt, we're able to open the doors up and do more things.
Yeah.
And what we'll do is we'll break down why it's so important for you to pay off your debt. Just stay rocking with us.
Yeah, we have a whole nother sheet to show you with that. So now that the MasterCard is paid off, we're going to redirect $150 back to us. So now in this instance, that's why you see the payment to yourself changes from $200 to $350 because, we skipped ahead. So now we see here, we're bringing the $200 that we were paying ourselves every single month. Now the $150 that we were paying MasterCard every single month, and we're paying ourselves. So this is truly powerful when we're talking about you understanding how to use your policy, because so many times people would just let this 7825 sit and then wait for whatever rainy day, whatever situation that comes your way, where you decide, oh, maybe I'll use this policy. But we have so many opportunities right now today where we can start redirecting the funds that are being paid out and pay them in our direction. And the other thing to notice is that with this, you're already paying yourself interest. Yeah. You don't even have to do the math to figure out how much interest am I going to pay myself, because with the Visa credit card and this MasterCard, it already includes interest. Right? If you're not paying your statements off every single month, you're paying interest on these loans on the credit cards.
And this is when we start doing banking. Just having a policy isn't doing banking or having a banking policy, so to speak. This is banking. When you're using your policy to do something, to accomplish something financially. And that's what we're doing here with our debt.
Yeah. So let's do this. Before we jump into this amortization schedule, are there any questions? We want to make sure that we go through your questions as they come up.
So one of the questions is, do you pay back monthly? Should I pay the policy back monthly? Yes. Pay the policy back monthly if that's what you want to do. What I do is I pay my policies back on a monthly basis because I have to feel like I'm paying something. And of course, I want to reduce my interest payments too.
But there were and there are instances where we pay our loans back on an annual basis, just so that you all know. So the answer is yes, pay it back monthly, pay it back annually, pay it back quarterly. Remember, it's your banking system, so you get to make the rules.
Right.
So it just depends on personal preference. What makes you feel good at night, what makes you sleep better at night, do that.
Right.
and we can't necessarily tell you what that is because it might be different for us.
Right. Another question is, so did we make $1,775? Yes, you did. You did make $1,775. What $1,775 is the difference between the $9,600 and the $7,825 that was the balance on this card.
Hold on, let me pull up the screen again because we just said a lot of numbers. I want to make sure that we're all tracking. So remember the exercise that I just had everyone do. I said, if you're going to pay $200 a month times 48 months, we all agreed that that number was $9,600. If you subtract $9,600 by the balance of what you owed Visa, that's what that amount comes to.
Yep.
So that difference is what you're pocketing, because otherwise that difference would go to Visa.
Yep. So $1,775 is what you made, because that's what Visa would have made. You made it yourself.
Exactly. So what else? Let's see. I see everything that's in here. Golden nuggets. Thank you so much. Thank you for the feedback. Good to know that you all are tracking. So does this work with any kind of insurance policy? No.
Well, this is
Yes
a regular,
no.
this is a regular life insurance policy. The only thing we did is added something called a paid
No,
up.
the question is any kind of insurance policy.
Oh, okay.
So
it has to be a dividend paying whole life insurance policy. What we get confused with sometimes, and what is talked about in Nelson Nash's book, Becoming Your Own Banker, is doing infinite banking. You don't want to use a universal life policy or variable life policy, because they weren't created they were created to mimic something else other than basically the bank. The whole life insurance policy, dividend whole life insurance policy, is more like a banking system than it is a life insurance policy. You just happen to get a death benefit from it. So
yeah, so building on to that is how about regular life insurance from work? So we're not sure what type of life insurance you have from work. However, I'm going to say typically that type of insurance is just term insurance. Typically, I don't know who your employer is or what those benefits are, but the only way that this is going to work is with a policy that has cash value. And to Darius's point, you can do it with variable life or index life or things like that, but you just have to understand how those policies work, because once you start requesting loans, there's different fees that are involved, and you're not always going to have amazing growth like you would with a policy that provides guarantees like a whole life insurance policy does. Yep. So just make sure you understand your illustrations and what's on there, because sometimes it shows phenomenal growth, but it's not a guarantee. So then the next thing is, it's not term life, or it doesn't need to have cash value. Yes, you kind of answered your own question.
Yeah. The next question is, where does the loan come from in August of 2022? It's when this person pays their second premium. Their second annual premium is when the $8,303 becomes available.
And the interesting thing to note is when you pay your premium every single year, and this is why we talk about your premiums being deposits, because every time you put money into the policy, there's more money available for you to borrow, regardless if you have an outstanding loan or not. Because if you see, we still had an outstanding loan. It wasn't all paid back, but the second year we were able to request more money. And that's because of the guaranteed growth within the policy.
And the next statement is, I don't think the math adds up. Well, we'll cover that in the next section where we break down the amortization schedule.
Okay, perfect. Interesting. Okay. So, can this only be done with full balance, or can I do this with half of the balance if I don't have enough cash value? You can do it with half of the balance if you need to. Fantastic question. In this instance, we're showing you where you can take all of your whole first loan and pay off a credit card. But if you have to do it in chunks, still do it, because you'll be able to do it more aggressively than if you were to just pay it every single month without chunking it down.
There we go. Now let's move on.
All right. So this amortization schedule, I like that challenge. I don't think the numbers add up. So let's just show you how that works.
So let's break down the numbers for the next 48 months. So this is a $7,825 credit card from MasterCard with a 10% annual interest rate, and the loan period is for 4 years.
Yeah. So, okay. What we just showed you is that this is this, right? So this is the balance, $78.25, paying $200. So just to make sure that we're all on the same page. All right. So, all right. So this is, it says MasterCard, but this is actually Visa. That was my fault. I misspoke. So in this instance, this is the Visa card that we were paying $200 on every single month. Our beginning balance, $78.25, showing how the payments are taking over the balance. So this is what we call an amortization schedule. And what this shows you is every single month, how the policy, in this instance, how the credit card is going to be paid off.
Right. So just going from the top, on a 48-month term, your payment number is going to be on the left side. And then you have your payment dates is going to be the first of each month, your beginning balance, your scheduled payment, which is $200. There's a column here for extra payments. What we do is if you want to make an extra payment, we can actually illustrate that in this system. The total payments, the principal, this is interesting, the principal and the interest. So whenever you make a $200 payment, there's $134.79 that goes towards your principal, and then the interest is $65.21. Now, the interest is the amount of money that we're able to make, because this is over and above what the actual amount that we use is for. We're paying it back plus interest. This is the money that the bank makes, or the credit card company makes. And then this is your ending balance after that payment.
Yeah. So let's take a moment really quickly, because for those of you who are in the chat, let us know when you think about how this works. If you owe 10% on a balance at $78.25, what do we assume that's going to be? Just let us know in the chat. But I want to know what you guys are thinking. If we owe 10% on a balance that's $78.25, what do you typically think you're going to pay in interest? Just take a moment and think about it, because a lot of times we don't really understand the things that we're getting into. We don't understand how credit cards work.
Exactly. $708.25. $782.
Yeah. But
$782.
Yeah. That's what we assume, right? If we're going to pay 10%. Thank you again for the engagement. If we're going to pay 10% on a balance at $78.25, we think it's probably 10% of that. But if we are questioning the math and how all of this works, just take a look at the interest. If you look at this interest column, every single month, the $200 payment that you're paying is being broken up between principal and interest. And this whole column right here, if you were to just pay Visa, Visa's getting this check every single month. Now just think about that, right? Because all we do is just use our credit cards. We swipe. We're like, oh, it's okay. I'll pay it off at some point. I'll pay it off at some point.
It's only 10% interest.
Yeah. Who's okay with sending $65 of free money? Visa didn't have to do anything, but just give you a piece of plastic. How many of you are okay of just sending Visa $65.21 the first month? Anybody okay with that? How about $64.09? You guys cool with that? $62.95. I don't hear y'all. One person said, no, there we go. Is there a delay? Like, is this thing on? What's going on? All right. So start thinking about this and how this is playing out. And look how we just jump. We said 48 months. We were just showing you the first 20 months. We're still sending checks to Visa
of $200, and not all of it is going towards our principal payment. Mm-hmm. What's happening is it's a decreasing value that we're paying on a monthly basis. So it starts off high and then it goes down. Mm-hmm. So for those of us who continue to use our credit cards often, then what do you think is happening to those interest payments? Do you think it's going down if we continue to use the credit card over and over again? Mm-hmm. No, mm-hmm. This is actually taking a snapshot of somebody that's saying, okay, I am going to finance my own lifestyle and I'm going to pay off this credit card. I'm only going to use it for certain things where I can pay it off at the end of every single month. And I'm just going to use my policy to finance the things that I need, mm-hmm. to where I can make monthly payments.
Exactly.
So in this example, you have.
Oh, wait, hold on one second. So I was going to say, in this example, for those of you who said you were paying about $780 in interest, that's what you thought. Guess what? No. How much are you paying? Look at what I'm circling down here. What you end up paying
in interest,
cumulative interest, is you're sending Visa a check at the end of 48 months. Cumulatively, you would have sent them $1,684.70.
Mm-hmm.
Congratulations, you're the owner of a Visa credit card. Not hating on the banks, right? We're not hating. All we have to do is we have to understand how they work. And now let's start applying that to our policy. So that's why we're redirecting those $200 payments to ourselves, because that $200 payment is going to include principal and interest. And now all of these checks that you were going to pay Visa are coming back to you.
Right. Now, what happened on the other credit card, which has a $5,000 balance, is, remember, we didn't have enough funds to pay that credit card off in the very first year, like we did the other credit card, the $7,825 credit card. So this starts at month 13 because we had what was left over is $3,731 that we borrowed from our credit card in August 2022. We borrowed from our policy in August of 2022. We paid this off.
Yeah.
Now that $150 is being added to the $200 that we're already paying ourselves.
So again, remember, a lot of times we're just looking at our scheduled payments. $150. Oh, that's nothing. I can afford $150 minimum payment, but not realizing that that $150, including principal and interest, and all of that money is being added up, being sent to the credit card companies.
So if we go back and we say we're paying $150 here on a $5,000 balance, but only $100 is being put towards the principal, the other $50 just went to interest.
So just look at everything that we're showing again today. And the point of us sharing this information with you is just for you to understand the concept.
Right.
Because what we are showing you on this screen, the plan that we just showed you, is something that we provide all of our members who are in the money school, who join us annually. So if you are interested in joining the money school, then definitely join us today, because each of our members who join us actually get their own flight plan. This is what we call it. It's a flight plan. And the point of this flight plan, again, is so you know, month by month, day by day, step by step, whatever it is for you that makes sense for you to understand how you can pay off debt. And remember, don't just focus on the debt. We understand many of you don't have debt. So if you don't have debt, we're going to show you next month exactly what it looks like to use your policy to invest, how to turn this around so that you can start financing your own deals and capturing all of that interest for yourself, as opposed to letting it go to whatever personal lender that you're talking about. So let me just jump really quickly, make sure that there's no other questions. I see everyone no. I saw a comment that said, I'm screaming no, you just didn't hear me. I love that. That money I can have for myself to pay another bill. Absolutely. You can roll it over. I saw something where it was like snowball. Absolutely. Snowball. You can take the $200. If you don't decide to pay yourself, you can use that to pay on another debt more aggressively.
Right. And as Carmen's going through the question, one thing is the interest payment back to the insurance company. How much is the interest payment going back to the insurance company? Well, it's not going to be more than 5% simple interest. So of the money that you made, remember, there's two options. You can take that monthly payment and pay it back to the insurance policy loan and reduce the amount of interest that you're charged on an annual basis, or you can put that in a separate checking account and just pay the interest at the end of the year. But here's the thing. When they give you your loan, they already take the interest out. They already take the interest out when they give you the loan.
Yep.
So what they do is you're not charged interest until the following year. So what they charge you interest on is what's outstanding. That's why on some of our policies on a monthly basis, we pay back the policy loan to the insurance company, because it would otherwise be sitting in our account. It's costing us more money to have that money sitting in our separate checking account than it does to just pay the loan back. So if we have no use for it, pay the money back on a monthly basis to the insurance company, just so we can build up that habit. And when we need the money again, we can always ask to borrow it.
Yeah. And I see some comments in here. My Visa interest rate is higher than this, and my car note is higher than 10%. You are paying a ton of money in interest, my friend, which is fine. Now you know better. So let's do better. Right. So what can we do with this information so that you can start reducing those interest rates and at least redirecting it to yourself? And I want to give a shout out to Miss Joyce Johnson. Joyce, if you want to show your beautiful face, give us a nice wave. Joyce is talking about amortization schedules. Always tell the truth. So Joyce is one of our amazing team members. She's our onboard manager, and she creates all of these flight plans for our clients. So again, if you join the Money School, you'll be able to work hand in hand with Joyce. We've worked with Joyce for many, many years, and she has so much wonderful experience and has created hundreds, thousands of these plans. And she really understands how to manipulate your flight plans so that it can tell your own story.
Yeah.
Because
hi, everybody. Sorry, it won't let me show my face, but hello, everybody.
No worries. No worries. Yeah. So it's important for you all to understand that, when you join the Money School, this isn't a cookie cutter approach. This is
because everybody's situation is different. Like our situation was different.
Mhm.
Not everybody starts off with $140,000 of credit card debt. We did. So we needed somebody, a special person like Joyce to help us figure out how to use our policies to pay off that debt.
I see something in here says, I usually pay double payments on my card. Is that good to do? Oh, I'm being dramatic, but no. Why are you giving your money away? Stop paying double payments. We don't recommend it. You asked the question, so I'm gonna tell you. We don't recommend that you pay double payments, because in this instance, if your credit card bill is $200, that means you're sending $400 to Visa. Granted, you are trying to pay it down more aggressively, but you're literally giving up $200 every single month, when maybe you could use that money more advantageous so that you can either create cash flow or do something, put it in a policy, do something with.
So the thing with credit card, the secret sauce with credit cards is to pay it off every single month so that you're not charged any interest. If you need to finance anything, that's why we use our life insurance policies to help with that financing. Now, there's certain things you can't necessarily pay off every month, like your mortgage. You have to get a loan and finance those things because it's a mortgage. It's more money than most people can pay cash for. But when it comes to something like credit cards, that's a flexible expense that we
good point,
that we get to decide whether or not we need this or we don't. And in the case of emergencies, that's what we have savings for. So buying something on our credit card that we can't pay it off every single month means we can't afford it, and we shouldn't buy it.
Yeah. So basically, the story is, if you can't pay your statement off every month, then give them the minimum, the bare minimum that you can pay the credit card company, and bank that other $200, whatever it is, in your savings so that you can keep it for yourself. And still you can throw a huge chunk at the credit card.
So why pay the bare minimum if you have more money?
Answer that. I like that.
Well, you pay the bare minimum because you're going to be doing something else with the money to make more money, so that you can more aggressively pay it off in the future. Like, for example, this is how we started saving money to get our first policy is, yes, we had $140,000 worth of credit card debt, but instead of putting all of our money inside that credit card so that we have to go back to it for an emergency, we started saving the funds and creating our own emergency fund. So we got to a point to where we had more money and we started a policy. We threw a large amount of the money at from our policy. We got a loan, we threw it at our credit card debt, we paid off 3 cards, and then we started redirecting those funds to pay off more debt and save more money.
Yeah. And this actually segues into the next question, which is, what if your only debt is your home? So same thing. If you cannot pay your debts off all the way, then only send the minimum payments. So if you have a home,
the key is the other part to that is you have to be doing something with that money to either be saving it or investing it. Because the last thing you want is to pay the minimum payment, but continue to use the money to get further and further in debt.
The money that you're referring to are like the extra payments that you would be paying.
Right.
Any extra funds that you're thinking of sending the bank, don't send it to them. Keep it for yourself so that you can create cash flow with.
So you don't have to use the credit card.
So you can make yourself ahead. So when we think about mortgages, with the mortgages, how it typically works is you either want to own all of it, meaning pay it off very quickly in one swoop, so to speak, or own none of it, meaning only send your minimum payment payments. And then when you get to the point where you're stacking cash on the side, you can then decide, you know what, does it make sense for me to throw all of this money at the mortgage, or should I throw all this money and get another house and maybe Airbnb it or whatever it is? You have to decide that. But every single time that you get paid, if you're sending double payments to the bank, now you're stripping yourself of being able to create any sort of cash flow because you're giving it right back to the bank. So what's the power of using your policy for a mortgage is when you get to the point where you have enough money built up in the policy, then throw it at the mortgage. Until then,
not throw it at the mortgage. What you do is you trade places with the mortgage, because what you want is that mortgage payment, you to be paying yourself that mortgage payment, and you recreating those interest payments.
Ownership transfer.
Right.
Sorry.
And
ownership
one thing that came up as we were talking about credit cards is I feel like when it comes to stuff like velocity banking, this is where a lot of people I think mess up is they get all these credit cards and they carry a balance. The point of it is to have a small balance. Like you can build your credit without having a balance. So you don't need to carry a balance in order to build your credit. And I think that's what some people go wrong with when it comes to their credit cards and how they manage it. Yeah,
they keep a balance. The point is for you to take ownership, trade ownership. Remember, so we said we paid off the credit card. Now we're paying $200 back to ourselves. We changed ownership, meaning we're no longer going to be using the credit card because now all of those funds are going to stay with us. So next time we need to finance something, where do we go? Our policy, because the cash is now in the policy and not on the credit card.
Or our own banking system.
So the next one says, you are making me want to get into the insurance business again. Come on, it's fun. Next comment, I would say, I would like to try this, but my policy is a 5% variable interest, unrecognized, and 6% direct recognized. Would you suggest that I do this? There was a typo in there that threw me off. But anyways, basically, do you recommend that I do this? Yes, still do it regardless. So what a lot of people don't understand is that the interest rates with the insurance companies, they're all variable. So our rate is a variable 4.7. It's really 5%. We just round up. So at the end of the day, you should always do this because you're starting to take control of your finances.
Right. And it won't change more than 0.5% without you getting a letter in the mail.
Is the Money School still taking students? Absolutely. It's always open enrollment. Come join us. Like I said, we'll tell you about one perk at the end of this if you guys stick with us. Hey guys, great content. I have no credit card debt. Thank God. Congratulations.
Good job.
I paid it off a few months ago in full. Woo woo. And let's see. And it was about $8,000.
Nice.
Which is basically our example you just mentioned. Should you wait for the next month? Yeah. Or, I mean, if you're thinking about getting a policy, I just want to make sure I understand your question. If you're thinking about getting a policy, get a policy regardless, because you have money that needs to be moved. And then you can just learn next month, by the time you have your policy in hand, if you don't have one already, how you can start using that policy to invest. I can theoretically pay my annual premium, say $20,000, and borrow some of it to pay expenses during the year. That thought keeps coming to me.
Well, if it starts cooking up here, that means you're supposed to be doing something.
Yeah, action. We got to take action. So the example again, don't miss the concept, ladies and gentlemen. Don't miss the concept that we just shared with you. The concept was paying off something. Regardless if it's debt, cash flow, expenses, we're putting money towards something. Every single month, we all have expenses that we have to pay, right? That's money that's leaving us. The concept that we want you to get is every time you have money leaving you, you need to figure out how to get it back. I don't care what it is. So how can you get it back? Start understanding how you're spending, what are your habits, things like that. And how can you use the cash inside your policy to start redirecting those payments back to you? It doesn't matter what it is. All right. So let me jump into the rest of the presentation real quick, and then we'll share a few more moments at the end to answer all of these questions. But I definitely want to make sure that we go through everything. So like Joyce said, our amazing team member, our onboard manager, she said, amortization schedules do not lie. They tell the truth. So in this example, for those of you who may be questioning the numbers, you can use all of these numbers yourself to double check and look at your own amortization schedule so that you can see exactly how this works. Because all we're literally doing is redirecting the funds that we would have had to pay the credit card company.
Right. And here's another example over the next 29 months. You have 12% interest on $3,731.75. 12% interest is more like $780 maybe. So I'm sorry, $380.
Yeah.
But what we see that we were able to recapture in just a short period of time is 580. So we looked at two examples, one over 4 years and one in over 1 year. $580 that we've been able to redirect
back to ourselves.
So interest is how they make money. Interest is how the credit card companies make money. This is how the banks make money. Interest is what keeps the lights on. So if you're able to redirect those interest payments back to you, you're making money that you would have otherwise spent. So your debt again becomes another man's cash flow, or in this case, your debt becomes your cash flow.
Exactly. I like that. So how about that interest? Everyone says, how about that apples? I think we're going to say, how about that interest? So what do you guys think? Because basically we have shown you the exact scenario that we would take to pay off our debt using a policy.
And this is exactly what we did with all the credit cards that we had, all $140,000 worth.
And maybe you all saw that on YouTube. We have a video showing exactly how we did that on YouTube. So that's why, again, for us, it gets back to, what do I do with this thing now that I have it? Well, we know exactly what to do with it. And we create flight plans for all of our members who are inside the money school. So when we think about just recapping exactly what it is, what we're doing is just recapping. Right. So everything that you have learned is how to redirect existing credit card payments to your private banking system in order for you to create cash flow and finance your lifestyle. Because if we're just talking about that $200 payment that we were paying ourselves every single month, we see how that $200 starts to add up month after month after month when we're paying it back to ourselves, and how that will now allow us to start financing our own lifestyle because we won't be so dependent on the products and services that the banks offer us.
Right. And when it comes to a bank, you have to think about what purpose does a bank serve and how we're able to accomplish this with our life insurance policy. So first off, every time you get paid, your money goes directly to a bank and it sits in the bank, or you think it's sitting in the bank, but they lend it out to somebody else. It's in a storage facility. What a life insurance policy becomes is a storage facility. Now, when it comes to lending that money out, you go to the bank, you get your car loan, credit cards, personal loans, whatever type of loan there is, they charge you interest on that. What you're able to do in this situation is borrow the money from the life insurance policy, and you pay back what you would have paid to the bank. You pay it back with interest. Now you're able to borrow and lend money, or lend money and make money using your life insurance policy. So you're able to put some of those very important keys in one place.
So what we want to just recap again, just like Darius was just showing or explaining, $200 was going to Visa every month. $150 was going to MasterCard every single month. So if we add that up, that's $350 a month that we're paying to credit card companies. Now, a lot of us may just go, oh, it's $200 or it's $150, but we don't realize again how much money that can be and how that accumulates year after year, which is why we showed you that it's actually $4,200 every single year that you're paying to credit cards. And you were just trying to finance something. A lot of times your purchases end up becoming much more expensive because of the interest that's now baked into the credit cards. So now you're overpaying for these items, but products, goods, services, whatever it is, because you didn't have the cash on hand, or we didn't have a plan in place to understand how we can best finance our own lifestyle or own our own lifestyle, like we always say. So what do we think about this?
Well, one thing I want to say is one thing that came to my mind is these monthly payments remind me of a pill. And if you think back on all the pills you've taken, let's say you have like high blood pressure as an example. You have high blood pressure and you take this one pill every single month for the next 4 years. You don't think about the fact that you're taking this pill every single day, but when you bring all those pills together and see how much pills you've taken over a certain period of time, it might scare you on how much stuff you put into your body to help you do something, to help you function. That's the same thing what I think banks do with these small payments is they make it palatable by breaking it up into small pieces. And what happens is we get comfortable with these small payments and not taking into consideration the fact that you have to pay this for the next
48 months.
48 months.
I like that. I like that. So if you want to start palleting your own financial payments, then we definitely suggest that you guys join us in the Money School. Now, one thing I want to share about the Money School, and then we'll wrap up and ask questions or answer questions, is what we really want to make sure, like we said, we built the Money Schools because we wanted to bring like-minded people together who all have policies or are aspiring to be policyholders. And again, you don't have to work with us. You can work with anyone you want. We hope that you choose us, but at the end of the day, this is for anyone, but it's not for everyone. We want to make sure that those of you who join the Money School today, since we've been talking about it, are ready to take action, get amazing results, and not make excuses. Right. This is only for those who are ready to take action. So just so you all know, in case you're asking what's included in the Money School, is access to the Money Blueprint. So like we just talked about, the Money Blueprint is one of our financial mastery courses where we walk you through step-by-step, module by module on how to achieve financial literacy. And next is private coaching inside our Money School. Basically, you'll be able to see Darius and I twice a month live, where we are going to break down all of the things that we're learning from our students, from ourselves, from our peers, as far as how you can continue to aggressively be a part of this Money School and be a part of your own banking system. Next is step-by-step guides and templates that we provide. There's not only a bunch of courses, there's 7 courses uploaded in the Money School right now that you can get your hands on starting today. We also have templates as far as like contracts, contract 101s, how you understand private lending, how that all works. And then the weekly power hours. So we'll definitely be shouting out content within the Money School every single week so that we can all be together. And then anything that we do moving forward, any upcoming courses, resources, or content that we put out, you will have access to. And you see the values next to each of these things, because Darius and I are putting all of our focus into the Money School so that we can make sure that you all continue to be aggressive with your banking system and start using them appropriately. Because the thing that we recognize is, not only as agents, when we sell you a policy, what we want you to do is continue to be successful. So it doesn't just stop at the policy. This is a journey, and we hope that you join us on this journey. So we know that when you add all of these values together, that total is actually $87,500. That's huge value that we are not charging you for, because we want this to be accessible to everyone. So if you join us today, you can either pay $119 monthly, or I said this earlier, a little nugget earlier, I don't know if you guys heard me. If you join today and you pay annually, $997 annually, you will be able to get your own flight plan. You can only get a flight plan if you join us in the annual membership. So if you want to join us today, go ahead and go to wealthnation.io/membership. You'll be able to get access to all of these things, and you'll have access to your own flight plan where you will work specifically with Joyce, our team member who's on the call today. She'll walk you through all of the needs that she needs to get from you, understanding your debt, your cash flow, what are your goals, and she'll put together a custom plan for you that you'll be able to update twice a year.
Right. Now, this is a good opportunity for you guys to also do banking, because if you take a look at the prices, $997 annually, what happens if you use your life insurance policy to finance this for $997 and pay yourself $120 on a monthly basis? You do the math. We just went over
it. We just shared exactly what you can do. So go ahead, join us today, join the Money School, wealthnation.io/membership. And what we're going to be doing for the month of August, the topic is, I have a policy, now what?
So
coincidence.
We're going to be going through different flight plans and different scenarios.
So you can join us and continue to learn and continue to be as aggressive as possible with your policies. So with that, we will now pause again for any questions. This is Q&A time. We have just a few more minutes before we jump off, because again, we want to respect everyone's time. So I see Priceless Gems. Let me know how I can sign up for the money class and get a whole life policy. So Joyce, if you will private message Bessie and just get in contact with her, we'll get you started, Bessie. But go ahead and click on that link in the chat. Miss Joyce has populated that for you to go ahead and join the membership. Let's see what else we have. This should be a high school and college course. Working on it, Tim.
We're working on it.
Working on it. If you have any hookups, let us know. We would love to get into the school systems.
You know what's funny, Tim, is I take my my nephews in high school and I take his worksheets. Wells Fargo actually does something about credit cards. And I take his worksheets and I go over it with him.
For those of you who already have policies, if you're our client, then absolutely the flight plan is available to you. So just clarifying that, I see that was one thing that came up. I have 2 loans that I can't lower the payments down and capture more money. Should I use a credit card to pay off the 2 loans so I can capture the money to open a policy?
No. What you have to do is don't get into more debt just to get a policy. The policy is just going to magnify what you're already doing. So my suggestion is make the minimum payment and pay yourself back. Pay yourself first for whatever that difference is. And when you get comfortable or to a point where you feel like you can start a policy, then go for it. But don't go in debt just to get a life insurance policy. Build up those small little habits now so that it can carry you through whatever you're going to be doing with your policy in the future.
Yeah. It's all about the habits. So start with cash at the end of the day, because, and the next thing to jump into that is the insurance companies always want cash payments. So we can't ever make payments through credit cards, to just in case somebody else was asking. So
we have a policy now. Can we use it to pay off taxes? Yes, absolutely.
Wait. Is taxes leaving your household? Is that cash leaving your household?
It is. I
think it is. I think taxes qualifies for you to be able to use your policy for that.
Yeah, we have a policy just for taxes. So whenever it's time to pay taxes, we use a life insurance policy and make payments back to ourselves so we can have it again for the next year.
And that's really about being proactive, because how many of us are proactive when it comes to our taxes? Yes, now we are. We didn't used to be, and that's why people are frantic right at the beginning of the year, the first quarter, trying to figure out, well, what are we going to do? What are we going to do? So if you can understand and gauge kind of how much money you're going to pay annually in taxes, then you can break that up in monthly payments, because that is the monthly payment that you're going to start paying yourself. Once you get the loan for your policy to pay off your taxes, then you'll start paying yourself monthly payments plus whatever interest you want to include in that. What is a flight plan? I'm thinking that this is maybe from earlier. What is a flight plan? Is that financial breakdown that we actually showed you. Let me actually go back to my screen so you can see the flight plan. And maybe we didn't say that, so I apologize if we didn't communicate that. But what a flight plan is this financial breakdown where we show you month by month exactly what you should be doing with your policy. So it'll look something similar to this, where you'll see, okay, this is the money I have to play with. I'm going to pay off the Visa card and I'm going to pay $200 a month back to myself. This is what the flight plan is. And this is what Joyce creates specifically for each of our clients and members, so that, again, you all understand where you should be month by month, how much money cumulatively you should have in your possession versus how much money you're paying yourself and how much money is still going out to a credit card or debt.
Right. And maybe just like Carmen said, maybe it's not a credit card. Maybe it's a personal loan you did to your business and you want to figure out how to pay yourself back plus that interest. Maybe it's a card that you bought for your business that you want to figure out how to pay it back. Maybe it's some type of investment like a mobile home, or you do fix and flips, or maybe it's an investment into like gap funding for a real estate property.
Yeah. Any expense. Anytime there is money leaving you,
there's an opportunity to make money.
Let's create a plan around it. Joyce, will you reach out to Michael on a private chat and send him or grab his email so that we can send him the deets to join? I see you're driving, Michael, so we don't want to make sure that you are safe on the road. So we'll make sure that we get you all the deets so that once you are settled, you can still join.
It's wealthnation.io/membership /membership.
I have 2 whole life policies. Would restructuring for IB be available in the money school? So are you saying maybe your current policies aren't high cash value policies and you're thinking of maybe converting them? If you are thinking about doing that, then that's definitely something that we can talk about inside the money school. Absolutely. Waiting for underwriting. Woo, fantastic. That's exciting. Outstanding presentation. Thank you guys. Thank you so much for the feedback. Let us know in the chat. Was this helpful? If this was helpful, say absolutely in the chat. I want to see nothing but absolutely. Thank you guys.
Or if you didn't like it, let us know too, so we can make some adjustments.
So we can make some adjustments. Thank you for the information about the policy.
So I'm stuttering because I stutter when I get excited.
It's all good.
But the reason why this is so near and dear to our heart is because this is how we learn this process ourselves. We surrounded ourselves with like-minded people who were doing the exact same thing that we're trying to accomplish. So we bounce ideas off of one another. And honestly, a lot of the new investments that we get or ideas we get are from people, our clients, and people trying to figure it out the exact same way we are.
One thing I was looking in the Q&A section, and yes, I like that you said that, Darius, because and again, I keep talking about the money school because it's just so important for those of you. We get emails, texts, calls every single day, comments on YouTube where people are like, how do I do this? How do I make this work? And we answered your question. Join us in the money school. We will show you every single month. You can be with us live. It's just about surrounding yourself with individuals who are taking action, people who are doing it, and people who know what's going on, and for you to be able to contribute as well. So make sure that you surround yourself with like-minded people who are doing great things so that you can level up, because you're always the sum of the 5 people that you are hanging out with.
Yeah.
Let's see. I think we answered all of the questions. Thank you all again for the feedback. Thank you so much. We see that this was valuable. So what we're going to do with the Wealth Nation community is every single month, the first Tuesday of the month, we're going to do a free webinar where we're just going to talk about topics that come up and how we can help you all solve the problems that you have out there. So let's see, any suggestions for those who are doing a refi right now with the record low interest rates? Refis can be tricky. And the reason why I think we both pause is because refis can be tricky, regardless that the interest rates are super low.
But it's still money that's going away from you.
Yeah. And the thing, and Chad, you probably know this because you're super smart, is when we do a refi, for those of you who may not know, when you're refinancing something, a house, a car, whatever it is, you have to realize that you're starting all over again. So it's hard for us to give you advice when we don't know necessarily where you were with your existing payments. You could have been just starting. So at a refi, yeah, it probably makes sense. Or you could have been 10 years into your mortgage. Do you do a refi? I don't know, because I don't know what the numbers are. But just always make sure that if you are refinancing something, you are starting all over again. So remember, all those money bags that you were sending to the bank, now you have to start over with a different term, different payments, and doing that all over again. So just make sure that it's worth the money, that you are actually saving money, because sometimes you're not, depending on how far into your existing loan you are.
And it also depends on what side of the refinance you're on also. Like it's a win-win for everybody involved. It's a win-win for you because you get a lower interest rate. Not so much the fact that you still have to start that term over. It's a win-win for the banks also, because you get to start over. And what happens with interest on items that have a long pay time, like a mortgage, 30 years, is all that interest is kind of packed in the first 7 years. So regardless if it's 2%, we did an example on this, regardless if it's 2%, you still have a lot more than 2% that you pay over a longer period of time because of the fact that it's over such a long period of time.
Yeah. So just think about that. Anyone who's thinking about refi, it's not always the best for you. Just do the math. Like we said, there's no fancy sauce. Math. Math is it.
I think I did the math some time ago on a $250,000 30-year mortgage at a 4.5% interest rate over 30 years. You pay $500,000 back. So this is just to give you an idea of what you could be doing when you refinance.
Yeah. Do you have to join the money school to get a policy? No, that they are independent from each other. So if you have a policy with us, amazing. If you want to further your education, join us in the money school. And again, just to clarify, you don't have to have a policy with us to join the money school. You don't even have to have a policy to join the money school. It's just all about action takers who are trying to
learn more and
do more and learn and finance their lifestyle. Can you get more than one policy? Absolutely. Yes. Well, I'm not going to say absolutely. It's all dependent on your income. So as long as your income
and your health
is worth insuring, then we just have to work with the insurance company to determine how many policies you can get.
Yeah.
Okay, I don't have a policy, but I'm interested. Join us in the money school. Can I please have Mrs. Joyce contact information? So let's make sure, Joyce, I'm sure you're probably talking to Karen offline. So I'll let you guys handle that. Thanks for sharing. Loved it. Changed my mindset. Don't go out to eat or entertainment. Save how you all are doing it. Now keep in mind, we're not saying don't do the things that you like to do, just redirect those funds.
Yeah.
So if you want to go out to eat, if you want to do entertainment, use your policy to pay for it and then pay yourself back plus interest.
Right.
Boom, baby. That's how you win. Because how much did it cost you? Nothing. You probably have a little bit more money in the bank, depending on how much you're charging yourself in interest.
And Terrell, what we want to open your mind up to is every time you spend money, there's an opportunity for you to make money because somebody is.
Mm-hmm. And thank you, Miss Laura. Appreciate it. Our member inside the Money School giving us a shout out. She's saying it's awesome. So much support from Carmen, Darius, and the entire community. Will this video be available? Yes, it will. We are going to edit it up, chop it up, and throw it on YouTube probably in about 2.5 weeks, but we'll send an email out so that you guys can see. Thank you guys. Love what you're doing. Thank you again. Money School, Money School, Money School. Join us in the Money School. If you join today and you sign up for the annual membership, you will be able to work exclusively with Miss Joyce and also us so that we can understand your goals and what it is that you're trying to do. We are just so excited for those of you who are challenging us, who are helping us level up, because like we said, we want you to surround yourself with people who are taking action. We want to surround ourselves with people who are taking action.
Right. And you won't just learn from us. You'll also learn from other people in the Money School who have different ideas on how they're investing their money to make more money.
Mm-hmm, exactly. And Jay, we see you. You guys rock. You rock, Jay, another member inside of our Money School, or one of our founding members. Is the Money School open for insurance agents? I'm a new insurance agent taking my license exam next week. Woo, there we go. Yes, absolutely. It's available to insurance agents, RIAs. It doesn't matter what you do.
Yeah, as long as you're trying
you
to
sell hot dogs, it doesn't matter.
Yeah, as long as you're using your policy to make money, then we want to talk to you.
Mm-hmm, absolutely. All right, guys, we are 8 minutes over. Thank you so much for rocking with us. We appreciate everything that you all do. Thank you for the support. Hit us up in YouTube. Continue to join our webinars. Like we said, next month, the first Tuesday of September, I believe it's the 7th, the day right after Labor Day, we will be live talking about how to use your policy to make money from your investments. So thank you guys again so much. We hope you have an amazing day. And remember to own your own lifestyle.
Or someone else will.
Bye, guys.
See ya.